Hello everybody, I am Vaishnavi and welcome to Allies Blue Online. In this video, we are going to learn all about the differences between two very important aspects of trading, that is futures and options. What are futures and options? How to trade in futures and options? What stocks are listed in futures and options? All your questions will be answered in this video, so keep watching. Before we get into the difference between futures and options, let's first understand how futures and options work. What is futures and options trading? Firstly, you need to understand that both futures and options are contracts or agreements between two people. So, the value of futures and options is derived from the underlying product or assets on which contract is made. The underlying asset may be a land, gold, share, or any product or service. So, whenever the price of the underlying asset rises, the price of futures and options also rise. And whenever the price of underlying falls, the price of futures and options will also fall. Now, there are three types of futures and options in stock market. First is equity futures and options, second is currency futures and options, and third is commodity futures and options. Confused? Let's understand futures and options in detail. Futures are stock, commodity, or any product at a fixed price on a future date. Let's first understand how futures and options work with the example of bikes. Imagine that Dev and Ram are best friends and Dev owns a bike showroom. Ram enters into a contract with Dev to buy a bike worth Rs 1 lakh in the next 3 months. Why does Ram enter into a contract with Dev to buy the bike in 3 months instead of directly purchasing it? Is it a contract between people to buy or sell instead of buying it right away? Here's why. Ram is currently short of funds and thinks the price of the bike will rise in the next 3 months. On the other hand, Dev agrees to enter into a contract as he thinks that the bike prices may drop. In the next 3 months, one of the following things may happen. The price of the bike might increase to Rs 1,20,000 and Dev might incur a loss of Rs 20,000. Or on the other hand, the price of the bike might decrease to Rs 75,000 and Ram might incur a loss of Rs 25,000. Or the price of the bike might remain the same. No profit, no loss. In the futures contract, both Dev and Ram cannot pull out the contract for the next 3 months. Doing so will lead to legal implications from either of the parties. Similarly, in the stock market, investors buy stock futures if they expect the price of the stock to increase in the future and short sell if they expect the price of the stock to decrease in the future. Both profits and losses are unlimited in futures contracts. Unlike the Dev and Ram example, in stock market futures contract, one can exit anytime they want by booking the profit or loss. Now moving on to options. Options contracts are similar to futures but with some differences. The difference can be better understood if we learn about options buying and options selling separately. Options buying. Unlike futures contract, here you will have to pay only the advance amount, that is the premium, to enter into the contract, and if the trade goes against you, you will lose the advance amount, that is the premium only. On the contrary, if the trade goes in your favor, you will make unlimited profits. Option selling. Here you will receive the premium from the option buyer and the profits will be limited to the premium received only. On the contrary, if the trade goes against you, your losses will be unlimited. Let's consider the Ram and Dev example again. Ram enters into the options contract with Dev to buy a bike worth Rs 1 lakh in the next 3 months, but this time pays an advance of Rs 10,000, which is the premium to book the bike. In the next 3 months, one of the following things may happen. The price of the bike might increase to Rs 1,20,000 and Dev might incur a loss of Rs 20,000. On the other hand, the price of the bike might decrease to Rs 75,000 and Ram might incur a loss of Rs 10,000 if he pulls out of the agreement. Or the price of the bike might remain same, no profit, no loss. The main difference between a futures and options contract is that in options contract, if Ram feels that the prices are going to drop, he can pull out of the contract and by doing so, he will lose only the advance amount, that is Rs 10,000. But Dev does not have any such option of pulling out of the contract. Now let us find out the differences between futures and options. When it comes to futures, both buyer and seller are obligated to buy and sell at an agreed price. But in options, option buyer is not obligated as he takes the risk by paying a premium or advance amount before entering into the contract. An option seller is obligated as he receives the premium or advance amount before entering into the contract. The second difference is that there are no advance payments required for futures and option buying, while the option seller receives an advance payment. The money required for futures and option selling is comparatively higher, and for options buying, you only have to pay the premium. For a detailed list of futures and options, check the description box below. Well, we've reached the end of the video. That was everything regarding futures and options. Thank you so much for watching. For more such informative videos, make sure that you're subscribed to Allies Blue Online. This is Vaishnavi signing off. I will see you in the next video.
Investment in securities markets are subject to market risks. Read all the related documents carefully before investing.